Hey YouTube, this is Zach with Achilles Financial, and today I'm going to be talking about STEM Inc. This is a fan favorite on the channel, one that I've been covering since their Star Peak Energy SPAC days. And today, following a very large debt raise utilizing convertible senior notes, which I will link directly in one of the cards right here in the top right hand corner, we hypothesized that they would be purchasing a company with the large amount of cash on their balance sheet, as well as the cash raise that they did via convertible senior notes. And today they announced that they would be purchasing a company called Also Energy. So that is available here. To talk about what this looks like, this is going to be a $695 million cash and stock deal. So 75% of this deal will be purchased utilizing cash on hand, and the remaining 25% is going to be being supplied via the stock of the company, and that'll be in common stock. You can see that down below, 75% and 25%. And again, this is expected to close in the first quarter of the year. The important thing to note is in 2020, year-end 2020, the revenues were $49 million, and they highlighted that they had 60% gross margin. Now, this was a company that had investor backing. However, I wasn't able to find any explicit financial statements as they are not a publicly traded company. However, some of the items that I would highlight that came out associated with this is we did have John Carrington, the CEO, come out and said that this would be a revenue and profitability accretive acquisition. What that means is that this is expected to be directly additional or directly beneficial to the bottom line from day one. So I'm excited to see what that actually looks like on the go live. This was a group that was backed by the Clairvest Group, and they own shares of STEM as well as Also Energy. So there's a lot to like about this deal. I am a big fan, but we also want to be asking questions about the valuation. So if the company had a 60, or we'll call it a $50 million year last year in 2020, and if we assume that they are a growing company in a similar fashion as STEM and STEM's competitor, Fluence Energy, both of which are growing very rapidly and doing very well over the course of the past 2 years, with a number of catalysts on the horizon, the question is the valuation appropriate for this deal? So if they closed $50 million last year, and I recognize that it is $49 million, then their price to sales ratio, if we were judging it by the public markets industry wide, is about 13x. So if they were going to be paying essentially 10x sales, that means that the company would have been closing around $650 million. Keep in mind that privately valued companies generally are going to hold a lower valuation than they would if they were looking at the public market. So the question is, if we're going off the industry number right here, to get to that $695 million number, they would essentially have had to be on target to close about $60 to $70 million in sales of this calendar year. And again, that's just an assumption. I would probably assume that there's benefits or some logic to that would make sense. But if that's what's in store and that's the idea, and we look at the total numbers and the expectations for STEM this calendar year, I'm going to be looking at the income statement on a quarterly basis. The expectation is in 2021, STEM is going to close $144 million in total sales. They've had repeated conversations where they could have backtracked on that or that could have changed, but at this point in time, we haven't seen any of that. The CEO, John Carrington, continues to push confidence in the company, despite the fact that they are seeing increased supply chain concerns as well as increased costs. That being said, the final quarter is expected to be in the $80 million range to close out the year. So if they hit $144 million, if the overall company that they just purchased in Also Energy is bringing on another $60 million or so, then that means this company will be coming in at over $200 million. So what does that mean for the stock? Right now, the company is not profitable at this point in time. They're not expected to be profitable on a GAAP basis, which is the only one that I personally care about, until 2023. Next year, we will be expecting a lot of what the company to be doing to be profitable. However, I think stock-based compensation will be weighing heavily on the company. There is going to be quite a bit of profit taking that has already begun. We'll be interested in watching how that poses going forward. However, I do want to highlight that if we're looking at the metrics right here for price to sales, they're currently, based on the 3 quarters they've closed thus far, trading at about 35 times sales. Price to sales, this is a very high ratio. I'm not a huge fan of valuing companies off price to sales, as it means that they are not making money, and we worry when companies are not making money because they may not be there forever. So if we assume that the company is going to hold a valuation more in line with the industry between 10 to 15 times sales, and the company is going to be closing the year with, say, 200 million in sales, well, what we do is we look at the fact that right now they're currently trading at a market capitalization of 2.6 billion. And unfortunately, when we trade a company at 10 to 15x sales, then you're going to be looking at a company trading between $2 and $3 billion based off of total sales of 200 million. Now, keep in mind, this is a very high growth company. People are going to have that forward-looking component. The 2022 numbers are expected to be near 300 million in total assets. It's a 50% increase in total growth. Again, looking at total sales volume in the same way, and if we were to value the company on price to sales based on 300 million, you would expect to see that to be at 3 billion to as much as 4.5 billion. Now, a $4.5 billion market cap on this stock under current shares outstanding, which I don't believe that will be the case in year end 2022. However, for current shares outstanding, that would put the company at a stock price of just north of $31 a share. So there's a lot to like about this transaction. There's a lot to like about the future of STEM. I think this has been baked in since the beginning, and I would expect that to continue to be so. The thing that we need to watch is, are they able to convert on this growth? Are they able to take advantage of items such as the Build Back Better plan, which has currently been shelved by the Senate at this point in time? I don't think that that'll be a this calendar year item, and it may be something that is focused on in the future, but there's still a lot to like about this transaction from a purely numbers perspective and from a purely stock investment perspective. Again, this is a company that has not received a lot of love from investors since the summer, but both sets of earnings that they have produced have been very much so in line with expectations, and they continue to perform very, very well. Keep in mind, this is a company that did go public at $10 a share through their SPAC merger, despite the fact that really after it was announced, it never really came back down. So we're still looking from those early investors. They're still showing an 80% return on investment. The question is going to be, where can the company go from here? A $31 share price sounds very, very nice, and there's a lot of ways that they can get there. And let's take a look at Also Energy and see why I think that company may help them get back up into that $30 to $35 a share bracket. So this is the website for Also Energy. You can see this has a lot of information available here. In terms of user interface, I always highlight this when we look at companies like this. We are not the ideal clientele. An investor is not necessarily looking at this in terms of identifying what is the most valuable user interface for us. It's going to be a lot more tech heavy in terms of what we have available in the platform, but there is a lot to like about the experience. What I'm going to be focused on is in their solutions capabilities. The first thing that we'll talk about is the PowerTrack platform. Essentially what this is this is showcasing the software capabilities of their platform to manage energy storage and provide dashboard level reporting. This is perfectly in line with Athena's platform today, in which case they are actually putting the hardware in place and then leveraging their own software capabilities. This is a company that is all over the place in terms of where they actually are and where they reside and what their market is. So you can see on this website that they are in quite a few countries, chiefly among them in terms of where they can expand and easily access. You can see the US, you can see Europe, China, Russia, Japan, South Korea. There is a lot of places that they are currently in use, The question is, does this expand STEM's footprint in a way that they can actively go after these markets, or is it still primarily going to be hardware driven? Keep in mind, in the push to profitability, it's still going to be largely driven by the software side versus the hardware side. So this should be directly beneficial to that goal. The question is going to be, how does this help them expand at a more rapid pace to where maybe they hit that $1 billion sale mark sooner than 2025? But there is a lot to like about the company, and you can see kind of how they've grown and what their platform has the capability of doing. I do believe most of the C-suite will be staying on. I haven't seen that get finalized. However, I expect there to be shakeups there as we continue to push forward. Overall, there is a lot to like about the company. They still have positions available on LinkedIn as well as on their website. So they do have jobs available, again, in Asia and Germany. It is an international company, but there's a lot of cool things to like about it. And it's definitely one that I'm going to be watching transform as they continue to grow. And you can see they are based in Boulder, Colorado. So this is something that we'll definitely be watching and see as it continues to grow. So therefore, what are we going to be looking at? So there are a number of things and easy approaches that I think can get the stock to 31 and as much as $40 a share. A lot of that is going to be growth driven. However, the company is getting ready to see a large decrease in their cash position, which admittedly is very, very healthy, sitting at north of $500 million as of Q3. They then went out and raised quite a bit more cash and another $400 million from those convertible senior debt offerings. And then they spent probably about 60 to 75% of that on this acquisition, as well as some additional dilution via stock. So the expectation is now they are going to be less cash capable at the current point in time. And how is that going to look going forward? Are they going to seek to raise more debt? Are they going to seek to increase their cash reserves by doing another share offering? At this point in time, the company has been pretty good stewards of the shareholder. However, that may change in the future and the benefits of the company as a whole, especially as they continue to trade at such a high valuation. But this is what I'm going to be watching going forward, is how do they treat the shareholder? Because all in all, this is a stock that trades under $20 a share right now. There's a lot of growth potential, and the company seems to be doing very, very well. Something I've said on this channel since the start is I'll continue to be buying into this stock until 2025. The reason for that is because, again, they continue to show exponential growth. They have a very strong management team, and I would expect to see them continue to grow by acquisition as well as organic growth. The target here that we're going to be looking at is going to be in line with that 2025 goal of more than $1 billion in sales. At that point in time, again, you would be looking at a valuation, if we're going off 10x sales and say 200 million shares, which would be another 30% more shares than is currently in place today, you would see a total valuation of $50 a share, which would put them right at a 150% increase from today's closing price. That is with a potential 30% baked in. However, I don't expect, and by 30%, I mean 30% dilution. I don't expect that to occur, but I do want to have that possibility laid out there. But all in all, if they continue to grow at this pace at current metrics, that could be a $75 to $100 share company. And that, again, is kind of a median estimate. The thing that I'm looking at is, what if this company does go parabolic? They do see growth where it's not $1 billion in sales, but it's $3 billion in sales. That's the idea I have for my hypothesis or my investment thesis for this company, is I already see this as being a more than 100% return over the course of the next 4 years. However, the upside is significantly higher in the fact that I think that this could be a company that could have 3 to 5 billion in revenue within the next 4 years, and that would put the valuation at as high as $150 to $250 a share. All of this is just my opinion. I've thrown out some price to sales models. I'll continue to update those as well. I'll be putting all of that in the Discord, which is linked in the description and is free to join and check out. We have a channel dedicated to STEM where we can talk about it. But all in all, the company looks like it made a very good acquisition in this approach. I have some concerns over the valuation. I just need more details, but it's something I'll continue to watch, and I have high expectations for the stock going forward. So if you have any questions, drop them in the comment section down below or in the Discord. Let me know if you found this video helpful by leaving a like and subscribing. It really helps the channel to grow. Appreciate you watching. Thanks. Talk to you later.